We all know Disney went woke, but now are they going to go broke? We'll talk about that and more on today's show. What is going on, investors? Hopefully, you guys are doing well out there. Picking up the story of the Walt Disney Company, one of the most iconic stocks in the stock market, ticker symbol DIS. Now, you're not going to believe this. Over the last year, I think you'll probably believe the stock has basically gone nowhere year to date. You are up 16%, but over the last 5 years, shares of Disney have gone nowhere. If you pull up a sideways chart, back in March of 2015, a lot of you guys probably weren't even investing in the stock market at that time. You could, this is almost a decade ago, you could have bought shares of Disney at the same price as they are today. Now, stock used to pay a larger dividend. They've just more recently reinstated that. We'll talk maybe a little bit about that, but we got to talk about these Q2 results. Revenue came in at $22.1 billion. That was good for flattish growth year over year. And if you start looking forward with Disney, Wall Street doesn't have really high expectations for this one. And this is a stock that if they do start outperforming the expectations, it would absolutely rally. You don't have a big valuation on this one. And the expectations are for kind of low to mid single digit growth out into the future for this company. The key with this company is they have two different business units, and they would do a big justice to shareholders, I think, if they were to separate these two companies, because you have the experience business. This is your Disneylands and your Disney Worlds. Look how great this business is. Revenue in the quarter went up 10% from $7.7 billion up to $8.4 billion. Look at your profit. You had margin expansion. Profit went up 12%, up from $2 billion over $2.3 billion. In terms of the total company, they generated about $3.9 billion of operating income. 2.3 of that is to Disneyland. When you stretch it out to a 6-month view, you have over $17.5 billion worth of revenue and over $5.4 billion worth of operating profits. And here's the thing about Disneyland is this is the 6th month that's kind of a down season, if you will. We're moving into spring and summertime when kids are off school and everybody wants to go to Disneyland. So profits are going to be expanding, and we'll see that a little bit with Disneyland or with Disney as they gave you guidance for the full year. They say the company remains on track to generate approximately $14 billion of cash provided by operations. And when you come over here and look at it, the company's not even halfway. They give you a 6-month view of their operating cash flows. They're at 5.8. So they're not even halfway there. My guess is they're expecting beautiful results from that Disneyland business. Now, problem is the rest of this company, should I say it? The rest of this company really actually sucks. Their entertainment business is down 5% year over year on a revenue basis from $10.3 billion down to $9.8 billion. Now, they've done a nice job controlling costs, squeezing costs there. So you had margin expansion there. Operating income up 72% from 455 up to 781. So despite lower revenue, slightly higher profits. But again, off of $9.8 billion to have $780 million in operating profits, this is a single-digit margin business. And the sports business is going to be nothing ever other than a low-margin business. The people that own NFL teams, NBA teams, Major League Baseball teams, these people are not stupid. They're not in the business to pump up Disney's operating profits in the sports division. In fact, when this number gets bigger, every single year when they come and renegotiate, they're going to drive the price higher and higher. You also have companies like Apple and Google and Amazon. They see this operating income and they say, well, we don't need that operating income. We can operate sports at basically break even or even a loss because it's going to drive business to some of our other categories. And you see over the last year, sports revenue on a quarterly basis actually climbed 2%. And this was a great quarter for sports. You had sky high ratings for March Madness, particularly in the women's basketball side. In fact, I think the women's final was like the highest rated college basketball game of all time, men's or women's. You had college football, you had NFL. It was a great quarter. So you only drove revenue up 2%, and look at your profits down 2%. It's always going to be like that. And so I think this company should separate these two businesses. Take the high margin, even the high growth business of the parks, separate it out into its own separate company. And what is that business worth? The entire Disney company is worth $208 billion. On a really good day, I think you could argue Disneyland might be worth $200 billion. And then whatever you get for this low margin entertainment and sports business, I think you take it. Now, company-wide, $22.1 billion. Again, that was basically flat year over year from a revenue perspective. Company has a lot of costs and expenses. It's not a software business. Over $19.2 billion in cost, but you noticed last year you had closer to 19.6. So nice job by Bob Iger coming in and reducing the cost a little bit. Now you have this restructuring and impairment charge. So if you didn't have this, it was actually a really good quarter. And that's what the company reports on their non-GAAP EPS of $1.21. You come here on a GAAP basis, they actually lost a penny and it looks really ugly. Here's your net income from 1.5 down to just $216 million, which again, on a $200 billion company just is never, ever going to cut it. But a lot of that, or all of that, actually is restructuring charge. So if you add this back in, you had over $2.2 billion of net income, and that compares very favorably to last year at just 1.5, and again, on basically no growth on the revenue side. So things are actually looking a little better than they seem on the surface. From a balance sheet perspective, we do see cash has left the building. From $26 billion, now you're down to about $18 billion. It didn't go to really repaying, it repaid some debt, but not a ton. So we'll have to come down here to cash flows to get a full story. We talked about for the full year, they're guiding for approximately $14 billion of cash provided by operating activities. That's this number on the bottom of your cash flow statement. And it got way better from $2.3 billion last year all the way up to $5.9 billion. And again, they're guiding for 14. So the back half of the year is going to be really good from a cash flow perspective. Again, I think most of that is going to be driven by a Disneyland. They have to invest in that parks business, but it seems like it's kind of annualizing out at about $2.6 billion. Now, the cash left the building largely due to an acquisition of $8.6 billion. They did buy back the stock a little bit, which I tell you what, when the stock is going sideways like this, I guess that's not the worst move. And they did reinstate that dividend that's very, very, very small from an operating cash flow perspective. So I tell you what, in my eyes, Disney's entertainment business, with all the competition for entertainment out there, not just from the studios, not just from Netflix, but like YouTube and obviously free content out there, I don't think they're ever going to be able to turn this into a high margin business. They're never going to turn sports into a high margin business. Like I said, the owners of these sports teams, they're not in the business to make Disney shareholders rich. They're in business to get themselves rich. So that's never going to be a high margin business. The experience business is where all the money is at. And I think they should separate the two companies because I think you could get a high multiple for a relatively high growth, high profit business, whereas the multiple you get on these two companies combined is relatively mediocre from an earnings and a sales perspective. And we've seen the stock has just performed mediocre. You could have bought shares 10 years ago at $105 per share. Now you could have got a total return probably slightly higher than that in terms of dividend payments because there were more consistent dividend payments at this time. But here we are at $105 per share. We've consolidated between really 91 and 120 on Disney. Breakouts above should signal a sell. Breakouts down below really should be of a high concern. While the stock has broken below this range before, continuing to retest that could bring some really ugly numbers because you don't have sideways consolidation or support on this stock till you get down into the 30s. A deterioration of Disneyland would likely send this stock down south of $50. But as long as Disneyland stays strong, the stock could probably hold where it's at, but it really doesn't have upward momentum unless somehow magically they turn the entertainment and TV and movie business into a high margin business. And again, the sports is just never going to happen. You might as well just give that up. I think the only hope for Disney shareholders is if they separate the two companies, you get a spin out and original shareholders of Disney either hold the parks business and the entertainment business is spun out and you get some kind of dividend or equity stake into that company or vice versa. Otherwise, you've got dead money here. And in a lot of ways, while Disney's probably not going to go broke, it's certainly not a great investment. Hopefully you guys enjoyed today's video. We'll be back again with more later this week. Good luck with your investments.